Hello, everybody, and welcome. This is Daniel Ackerman. I'm a listing specialist with the Queen's Home Team, and welcome to the channel. If you're joining us on the podcast, audio only, thanks so much. We're available on iTunes and anywhere else that you choose to get your podcasts. So you can always subscribe to our channel and download all of our episodes. And this is going out simultaneously on YouTube. So if you're joining us on YouTube, thank you, welcome, and make sure to subscribe and hit the bell icon, and you'll get all of the notifications of any new episode that we post on the channel. So what I want to talk about today is not something sort of like real estate specific. I mean, it is real estate specific, but it's not on a particular topic like we often do here on our channel. I want to talk today about perspectives, keeping perspective in the real estate world and in general with what's going on today in terms of interest rates, in terms of mortgages, inflation, recession, all of these things that you're seeing on the news, all of the dire predictions. So I wanted to take some time today and kind of put things in perspective, both the good, the bad, and the ugly. And what inspired this was really an article that I came across on a service called Visual Capitalist. It's something I subscribe to, and I get emails from Visual Capitalist, and it's a cool service. If you're not familiar with it, you can look it up, or we might put a link to it in the description of the video or the episode. And what they do is they basically just put out infographics, interesting infographics on all kinds of different things. But in any case, an email came to me from Visual Capitalist with an infographic on 40 years of interest rates, the history of 40 years of interest rates. And it was really jarring to see, and not for the reasons that people might think. It really put into perspective where we are right now and how good things actually are, relatively speaking, with regards to interest rates and mortgages. Now, a lot of you listening and watching me are probably thinking, this guy's crazy. What is he talking about, that the interest rates are good when they're almost three times what they were just a year and a half ago? Well, that's a fair point. It's a fair question. And that's exactly what we're going to look at. And I'm going to throw in some other stuff too. Things that I've been coming across in my work, talking to sellers, talking to buyers, talking to our teammates, and different perspectives that are important right now, and keeping things in perspective so that, one, you realize you're dealing with the world as it is, not as you'd like it to be. Perspective is very important in that regard, because you can't achieve the things that you want to achieve if you are not confronting the world with what it is presenting you and what the reality actually is. So obviously, if you're a buyer looking to buy a property right now, and interest rates are bouncing back and forth on either side of 7%, when 2 years ago they might have been at 2.5 or 2 3/4, that is a reality that is going to be impactful to you, and it definitely is a dramatic change. At the same time, if you're a seller and you're trying to sell a property for the same price that the property would have sold at a year ago or a year and a half ago, when interest rates were so much lower, you're going to be dealing with an unpleasant surprise, because you're going to have trouble making that goal happen because you're not dealing with the reality that's in front of us. Likewise, if you're a buyer and you're thinking, oh my gosh, 7% interest, the sky is falling, we're going into a recession, this is a calamity, et cetera, et cetera. Well, when you take a couple of steps back and you take a broader look, we'll see that that's actually not the case. And that things are actually, when you take a larger scale view, a higher view, you'll see that things are actually in a pretty good spot right now, relatively speaking. If you're looking at a 6-month or an 8-month or a 12-month time frame, then yeah, interest rates have gone up a lot, and we are dealing with an uncertain situation right now. And there's a lot of uncertainty for both buyers and sellers. But I wanted to kind of put this in a broader context so that people can feel more grounded in where things actually stand. Not just the headlines, not just the sound bites, not just the dire predictions that you're seeing, every night on CNN or Fox News, whatever you choose to watch. We're looking at just numbers and what they mean and how they compare to numbers, not just last year or the year before, but 10 years ago, 15 years ago, 20, 30 years ago. And I think that that's really instructive to gaining perspective in where we are right now. So I mentioned talking about the good, the bad, and the ugly. So let's start with the ugly. I was just analyzing a property that is going to be coming soon. We're going to be listing it in the next week or so. This is being recorded. Today is October 16th of 2022, and this is going to be listed probably next week. So this is a coming soon listing that I have coming in Astoria. It's a 3-family property, great property. And as I was running comps on it, looking at the comparable sales and doing a financial analysis of what would be entailed purchasing this property, it became really eye-opening to see how different the reality is for buyers right now. And I'll be honest with you, I was looking because this is a property that I was interested in potentially buying. I saw this and I thought, oh my gosh, this would be perfect for me and my wife. A 3-family property in Astoria. You can offset the mortgage with some of the rent that you generate. It's in a perfect location. It's got parking. I thought, this is great. I want to look at what it would take to buy this. So I started crunching the numbers. And the only thing I played with was the interest rate to see what it would have been like if I had bought it. We bought a home about 2 years ago, and we bought it when interest rates were at the bottom. They were at 2.5%, 2.75%. So we bought at the perfect time in terms of interest rates. And I'm not suggesting that people try to time the market, because you can't. We just got lucky, and we happened to buy at the very, very bottom of the market in terms of the rates. And we locked in 2.5%, 2.75%, something like that. So I'm looking at this property. Now this is going to be listed at a little over 1.6 million, actually 1,649,000. So I was looking at what the mortgage payment would have been if we purchased it when we purchased our home back in 2020, I believe it was, and had that low interest rate. And with all the calculations, I was looking at something around 7,700, 7,800 mortgage. That's mortgage, interest, and taxes amortized, over the year. So monthly, it would have been about $7,800. And then assuming that we could have rented 2 of the units for about $2,000 each, we would have decreased that by another $4,000. So our monthly housing payment would have been maybe $3,800 if we had bought it for that list price at 2.5%, 2.75%. Fast forward to this year, interest rates now are around 7%. And so I kept all the numbers the same, and all I did was change the interest rate to 7%. And boy, what a big difference. The monthly payment now for, principal, interest, taxes, insurance, which is the same thing that I calculated on the previous example. Instead of 7,800, now the monthly payment for PITI, PITI, principal, interest, taxes, and insurance, was now over $11,700. So from $7,800 to $11,700. It was shocking. That's a huge increase. So that brings perspective to what we're dealing with right now in terms of where buyers are at compared to where they were a year and a half ago. It's a totally different ballgame. And it looks bad. I mean, it's shocking. It looks like a really difficult situation. So that 11,700, by the way, once I deducted, say, 2,000 per unit in rent, brought me back down to 7,700. So I need those $4,000 in rent just to be at the same monthly payment as the gross PITI of 2 years ago. So that really brings into perspective how big of an increase and how impactful those increases in mortgage rates are to buyers today. And that should bring perspective to you as a seller in terms of your customers. Your customers are the buyers. These are the people that are going to buy your home. These are the people who are going to bring you the check that you need in order to close. But this is what they're dealing with, is a huge, huge increase. And so in order to find those customers, in order to find those buyers for your product, which is the home that you're selling, I think you can see the writing on the wall. The prices need to be lower. So that's the short-term perspective, relatively short-term. We're talking about an 18-month, 24-month spread. But now let's take a step back. And again, I'll put a link to this Visual Capitalist infographic. Let's take a few steps back. And we look back at interest rates over the last 40 years. And for those of you watching on YouTube, I'll try and throw this up on the screen. And we can see that the peak on this graph, which goes back to the early 80s, obviously 1982, the peak of the graph is 15.8%, which would have been, looks like around 82, 83. And there, at the same time that there was a recession. Okay. And you'll see that this graph, it's a bit up and down, but you see that the general trend line has gone down and down and down and down to the bottom, which was around December of 2020. Okay. So we've been on a downward trajectory for the last 40 years. Yes, there have been increases. Yes, there have been peaks and valleys along the way, but the overall slope is averaging downwards. If you look around 1986, there was a deep trough and then it spiked up again, but then it comes back down. And then it spikes up and then it comes back down. And each time it went further and further down. Now, right now, from basically December of 2020, January 2021, to today, we see another one of these spikes going up. But if you look at this graph, those spikes happen just about every 5 years. And if you go back to this graph, you'll see that actually in 2016, 17, we were at another sort of peak and then we came down and now we're going back up again. So looking at this with a broader sort of scale, it makes it look less alarming and more of just the natural progression of things. Okay. Now the treasury yield curve is inverted and it's at its lowest point in 2 decades. All of this stuff is signaling that we're probably going to a recession. And that's not a big surprise because the Fed, they have said their priority is to tamp down on inflation because inflation is a big destabilizer to an economy. And so they want to tamp down on that. That's their top priority. They're willing to trigger a recession in order to get inflation under control. Now, we're not getting into whether that's a good thing or a bad thing. That's a very loaded argument based on different views of economics, different political views. But it is what it is. They are willing to trigger a recession in order to tamp down inflation because to them, the drawback of a recession is way less important than getting the economy stabilized so that you don't have inflation. Because inflation is basically an economy that's out of balance, right? And the Fed, their whole deal is to get balance in the economy. Now, I'm going to connect these dots, but basically, it's important to understand that that's the Fed's goal. The Fed's goal is always to maintain balance to the economy. They want to keep inflation at around 2%, give or take a couple of tenths. They want to keep, economy growth, GDP growth around between 2 and 4%, give or take a couple of tenths. They want to see 3 to 4, 5% unemployment. All of these numbers, they want to keep in those sort of low percentage areas. Low and slow, really easy, nothing too drastic. So inflation, 1.5 to 2%, GDP growth between 2 and 4. This is the kind of thing that they're looking for. And this is going to become important. I'm going to connect these dots in a bit. But I thought it was important to talk about that perspective that over 40 years, when you take the broad view, we're not in a catastrophic situation here with 7% interest. So let's look back to before the housing crash and see what interest rates were like then. Now, I'm reading off my screen here. Now, you can go to a couple of other websites. You can go to themortgagereports.com. We like to use Mortgage News Daily. You can go to Quicken Loans. They have a lot of historical information. And if you look at the interest rates in 2007, now remember what the 2007 housing market was like. It was on fire. People were going crazy to buy homes, especially on the West Coast in the Bay Area, but all over the place. It was a hot market, and it was driving the prices up like crazy. And that's where you had the whole subprime loan crisis come out of, because everybody wanted to get in on the action, and mortgage companies were playing fast and loose with the requirements for loans. So in 2007, in that environment, mortgage interest rates were 6.34%. And today we're hovering around 6.9. So not that different, right? What the perspective that I want to bring here is that the reason we are feeling the shock of this change is because it's so much greater than where we were last year or the year before. But remember, interest rates were slashed by the Fed as a result of the crash in the housing market. They needed to stimulate the economy because the economy was crashing. How do they stimulate the economy? By lowering interest rates, right? What is their goal? To keep the economy stable. Once it stabilizes, then interest rates don't change so much. So they went down to zero almost. And then in the following years, as things stabilized, they pretty much hovered around that 2-3% range for a long, long time. And then what happened? Well, then we had the pandemic and another crash in the economy because everything got shut down. So now, again, the Fed needed to stimulate rates, and they start dropping them again until we had mortgage interest rates hovering around 2.5, 3%. Again, historic lows. But it was a temporary situation because we were dealing with a crisis situation and the Fed needed to stimulate the economy. But that's not where we're headed. Now we're on the flip side of that pandemic. Inflation was always going to be a natural result of having people come out, shopping again, looking for stuff. And now all the supply chains have been devastated by the pandemic and can't keep up. That, along with wars and fuel costs and all these other things, have created a worldwide environment where you have inflation basically just running rampant like a wildfire, and everybody's trying to control it. And the Fed's job, how do they control inflation? By raising interest rates, right? Now, this is another perspective that's important to gain. Let me back up. This is something that we should get used to as the new normal. Because once the economy stabilizes, the Fed is not going to have a reason to drop interest rates again. They only need to drop interest rates to stimulate an economy when an economy is out of balance. Remember, they just want to get the economy to be balanced. So they're going to raise the interest rates until inflation is under control and the economy is in balance. And then you can pretty much expect that There might be a subtle drop in interest rates, but you can pretty much expect that this is going to be the new normal because there won't be a reason for the Fed to drop rates substantially because the economy's in balance. So the other perspective that I want listeners, viewers to take away from this is that, yes, this is shocking because it's a big change from where we were a year and a half ago, 2 years ago. But where we were a year and a half ago, 2 years ago, was also a once in a generation crisis. So now we're out of balance. We need to find that balance. And once we do, we're going to be at the new normal. So if your goal is to buy a home, buy an investment property, assume that these interest rates are going to be in place for a while. So you shouldn't wait for, I'm going to wait for interest rates to drop. Well, you could be waiting 5, 10, 15 years. Is that how long you want to wait to buy the property that you want to buy, whether it's an investment property or a property to live in? If you're trying to sell, I'm going to wait until prices come back to where they were. They haven't even dropped that much right now, but they will. They will drop as a result of the higher interest and the lower demand, the struggle that buyers are going to go through. Sellers are not going to be able to get what they got a year and a half ago, 2 years ago. So if you're waiting to get back to where the peak was, well, you're going to be in for a long wait because typically that wait is about a 3 to 5 year cycle. So if you can afford to wait 5 years and wait for the market to, exceed the previous peak, great. Wait 5 years. But if moving, selling, maybe you want to retire and move out of state, maybe you need to get rid of a property for whatever reason, maybe it's an investment property that you want to offload. If selling it is a goal, just deal with the reality that's in front of you right now and realize that the situation that we have is a drastic change from 6 months ago or a year ago, but it's not the end of the world. The perspective that you get from looking at the broad, longer timeline is that we've been here before, and we've been here in good environments, good market environments. Obviously, every market is different, and right now we're dealing with factors that you weren't seeing in 2007. There wasn't inflation in 2007 like we're seeing now. This inflation is historically high, higher inflation than we've seen in 20, 30 years. But as far as the mortgage interest rates, keep perspective, keep your feet on the ground. Yes, it's a lot higher than it has been, but realize that it could be a lot worse. We don't have 15.8% interest like we did in 1982. We're still at historically low rates. If you look at that infographic from Visual Capitalist and you draw a line across where we are right now in interest rates, you'll see that the last time interest rates were here was about maybe even 2016 for the average interest rates. And then you go all the way back to 2010. But anything before that was pretty much higher. So from 1982 to 2000, say 6, 7, somewhere in there, interest rates have been higher than what they are today. So you still have it pretty good. Inflation will get under control. The economy will be rebalanced. And then we're going to settle into this as a new normal. It might be a little lower. We might settle at 6, 6.5, but we might settle at 7. We don't know. And that's not going to be the end of the world because we've had markets that have been much, much, much higher interest rates than that. And we've done fine. Just realize the bigger picture and get settled into this as your new normal and figure out the plan. And if you need help with that, then let us know. So I hope that brings you all perspective. I hope that this has been helpful. I find it always very helpful to calm things down when I take a broader view, take a step back and look at a high level view of things, because sometimes you can get you miss the forest for the trees, and the things that you want to accomplish can be accomplished. It just may take a little bit of looking at it from a different perspective once again. So thank you so much for watching and listening. Please subscribe to our channels, and we'd love your feedback and questions. You can email us directly at info@queenshometeam.com. You can email me at daniel@queenshometeam.com. Leave questions and comments below if you're watching on YouTube. And thank you so much for joining us. And we hope that you'll come back again soon. Bye-bye.